All right, so what we want to do today is we want to take a look at the one of the statements, which is the statement of activity. All right. So what is the statement of activity? Well, what basis is it used on, prepared on? The statement of activity is prepared on an accrual basis, right? Okay. So we will take a look at that, and that's why we see operating expenses and revenues, and that's the governmental activities area. Okay. We'll try to look at the various sources of revenues within, within the governmental general fund itself, and we'll see how they are classified. Okay, and we'll take a look at journal entries. This is now we'll start to delve into journal entries. Everybody like journal entries? Well, okay. You'll really like them next on Friday, when you'll be bombarded with them. Today is a brief introduction to journal entries. Well, how can you study accounting without journal entries, right? So we'll be taking a look at the journal entries here on how to record the annual budget, which is our financial plan, how to account for revenues, encumbrances, expenditures, and then this other term called allotment. And we'll take a look at this. See, when I started teaching you this last time, I tried to save some of the stuff because I didn't want you to get too discouraged. But today we are going to be preparing we're going to be using another set of general ledger accounts. And these are made-up accounts. Okay? So it's like working with two ledgers at the same time. So we'll deal with that. And then we'll talk about, what should be in a governmental accounting information system. And as far as the last item about public school systems, I think I'll skip that one because it's a very highly specialized area. And if you want to look at it at the back, that's fine. But if we have time, we'll touch upon it. If not, I'll let you know as we get through this. All right. So the first is the government-wide statement of activity. One thing you'll notice here is that you have expenses, not expenditures, right? And these are classified into several categories. Okay. So what you have is with the statement of activity, and let's try to see if we can take a look at that. Let me see what page that's on. Actually, go to page 67. I'll try to get on the web so I can get the electronic edition of the book. Okay, everybody see the statement on page 67? All right. Now this is a much easier statement to look at, and just bear with me. What I want you to do is, I want you to look at the left side of the statement and tell me what you see. What you see are the programs, right? Okay. I'm sorry, I should have done this earlier, but okay, this is to the electronic book so we can all look at this. Anybody use the electronic book? How do you like it? It's okay? For a hard copy? Okay. You prefer a hard copy. Yeah. Okay. I'm sorry, this took a little while, but this is what we want to do. All right, let's take a quick look at this. See all the different functions. What are some of the functions that you know that governments are involved in? What do they do? What are some of the functions? Yep. Well, yeah, social, but what are some? First thing comes to your mind is public safety, right? Police. What else? Education. Various different types of functions government might be involved in. What do? You put the direct cost of operating that on the left. Okay? And notice the format of the statement. The format of the statement shows the expenses minus the program revenues, or for lack of a better word, I don't want to use program revenues, but direct revenues. Revenues which are directly attributable to the function itself, be it charges for services, be it a grant specifically for that function itself. So the format is expenses minus program revenues equals the net. And then look at the general revenues that go on at the bottom. You'll always see taxes, okay? The taxes are always shown as general revenues. And look at some of the other items. You see grants, you see investment earnings, you see special items, and any extraordinary items. We will cover each one of those, okay? But this is the statement that you should know how to prepare, all right? And we'll go through each one of these. Notice one thing. Interest on long-term debt, always shown as a separate line item, okay? Never allocated to the function, shown as a separate line item itself, okay? Do you see any depreciation here? Where do you think depreciation goes? No. Depreciation expense, because now we're treating it like, where would depreciation go? It's included in the functional expenses. So basically what happens is we show the direct cost of each function, we show any indirect costs, and then we show the interest on long-term debt. Okay, so just keep that in mind. All right, moving along. Let me go back. Program revenues. As I said, these are reported, these are revenues which are received directly by the program itself, charges for services, for building inspections, for all different types of revenues, and we'll take a look at some of the examples that can be attributed directly to the function itself, okay? All right? Guys in the back, I know as far as use of laptops, all right, I'd appreciate it. Unless you really, really have to, no. Huh? Oh, your book is on there. Your book's on there. Just, you're taking notes. Now, I see I got all these reasons. But, try to, with the books, I can understand this. Because the problem is, see, if I allow some people, then everybody, just to be fair, everybody would say, they need to do that too. So if you have the book, what I'll do is I'll bring up the book page itself. When we refer to a certain illustration, okay, I'll bring it up. All right? And when we go through the homework assignments, you can use the laptop. Okay? Because I'll tell you, you might not think, but just by looking at your eyes, I can tell what you're doing. No, I know. Okay. No, I'm just kidding. By the way, what do your other instructors do about laptop use in the class? I'm just curious. Yeah, they don't want. How about what do most people? Where do most people fall, the instructors? Yeah, up to the student. All right, you can take your laptop out. Okay. Yeah. All right? Okay. So anyway, going ahead with this, general revenue. So what is a prime example of general revenue? Taxes, right? That's what comes to you, right? Okay. Let's take a look at, and I want you to see if you understand this by going to take a look at on page 98, an example of your being able to distinguish this. You can get your laptop out. Yeah, sure. Page 98, 3-4. Read the question, and let's try to figure out if you know the distinction. So once again, what's the distinction? Program revenues are specific to the function, right? Okay, good. So let's take a look at the first one, which is, the first question is, an unrestricted operating grant that can be used at the discretion of the city. Is that general revenue or program revenue? Why do you say general revenue? Because it's unrestricted. If it was a grant, for instance, to buy some police cars, where would you show it? For public safety, it would show up as a program revenue itself. And you might say, where is that? Well, if you look at it, that's here. See these grants? This is where it would show up. But this question right here, operating or capital grants, this is where a specific grant would show up. But the one that we just looked at shows up where? Out here. See that? Right here. Okay? All right, number 2, or B. Okay, restricted for highway construction. Again, purpose, right? Okay. Charges for building inspection. Building inspection, so you want to build a building, and what do? You file an application, and you put a fee because somebody has to review it, so it's program revenue, it's a service. Special assessment for snow removal. Now, you don't know anything about special assessment, but just read the question as it seems to you right now. What do you think it is? Program revenue, right? Okay. Fines and forfeits. Okay, now this is an interesting question, because even though you might consider fines and forfeits to be directly involved with police type of activity, but it shows up as what? General revenue. Motor vehicle fuel taxes restricted for road repairs. All right. What did I say about taxes? Any kind of taxes, because it's a tax, it's general. Okay. Unrestricted investment earnings. It's general revenue. I think you get the hang of it. You get the hang of what the difference is between program revenues and general revenues. Everybody see that? So if somebody gives you a grant, you ask them, what is it for? If it's just a general grant for anything that you could use, it goes down there. If it's for a specific purpose, it goes up on the top. Okay? All right. So far, so good? Okay. So, and this is what we talked about. These are program revenues are, charges for services, operating grants, capital grants, and this is the net format that we use in that statement, as you see. Okay. Nothing new. I think we've covered this. Okay. The key here is taxes of all kinds. General revenues always at the lower section of the statement. Now, why do we do this? Why do we separate these program revenues? Why don't we just put it all together? No, but why, for instance, building permit fees, which shows up as program revenue? Why not just throw them all into general revenue? Well, because you want to know, the net cost of that activity, right? Because expenses minus program revenue equals net cost, right? So you want to know what the net cost is. And that's why you see the format is never revenues minus expenses. It's what? expenses minus revenue, because you know that expenses will always exceed the revenues because they have to be covered by general revenue or taxes. Okay? And the last point is unrestricted earnings on endowment and permanent fund investment, which is that any kind of interest earnings or investment earnings on permanent funds or endowments are shown here. Not fiduciary funds, but what? Permanent funds, those which are within the government. Okay? And contributions to endowment and permanent funds and transfers between. So if somebody gave the township money, this is where it would show up in the general revenue itself. Okay? Let's take a look at what extraordinary item and special items are. And this is interesting because so for those of you who read the book and you see what's an extraordinary item which might show up on a statement of activity? What could it be? Yeah? Volcano cleanup. Well, you know what it could be? It's something that is a result mostly of a natural disaster, because it's not within our control. Be it a flood, a hurricane, and it's interesting because in the other class I mentioned this, and there was a very smart student there, and I said a hurricane. And it's funny because I used the example of Florida, and she said, but hold on a moment. That's a recurring thing in Florida. That's not extraordinary. And I corrected myself because I said, yes, if it were a hurricane which Florida gets one in 50 years or 100 years, some really unusual event, then it would be extraordinary. If it were not, then it's not extraordinary. Okay? So you have to look at it. And what might, so it's usually damage from that. What's a special item? A special item might be, what? Well, no, a parade hopefully won't cost. This is like something which is really material, okay? So in this case, it would be an item where the government is involved in, which is not normal. For instance, on New Jersey Statement of Activity, sale of Interstate 95 to New Jersey Turnpike and the money that's received. That's a special item because it's still within the governor's control, it's still within the management's control, but it's a special item. So it's usually sale of government assets. Okay? Yeah.
What if you have to hold special elections and controller, like you have to give your shop?
Yeah. No, this is, again, we're talking about the cost associated, a material cost. Yeah, there could be costs, but I'm talking more about big items. Yeah. Everybody cool with this? The two differences? Okay. All right. Oh, there is on page 109. Let's turn to that. Actually, there's I see why I put that in here. Based on what you have learned so far, looking at that statement, take a look at this for a couple of minutes and tell me a few things. Okay, first I'll let you look at it. Okay. So, by the way, how many functions does this have, this place have? Good. And what are they? Excellent. 4 functions, right? Now tell me, based on that, do you think you can prepare a statement of activity? Yeah. No, but using that format, right? Because it has all the information that you need, which is right here. And you should be able to do that, right? Using this, but it has to be, in order to do the statement of activity, you need this type of information, right? You need information on program expenses. You need information on program revenues. You need information on general revenues. You need information on extraordinary and special items, and any interest on long-term debt or grants that they have received, right? Okay. And that's the reason why I wanted to refer this to you, because if you were, in order to test yourself, you should try to do the statement yourself. See if you can do this. Not now, but try to practice, okay? All right, moving ahead. So these are the general functions that we talk about, okay? Public safety, public works, cultural recreation, health and welfare, okay? Actually, it's okay. So taking a look at this, these are the purposes. Now, let me put yourself in a municipality. You are the CFO of that organization. And it's time. You receive a memo from the mayor saying it's time to prepare the budget. Okay, I'm ready. And you quickly do your math and you say, okay, I looked up the account balances. For each one of these items, this is what we are going to spend this year. So you know what, we should at least budget this much for next year. And maybe a little bit more for inflation. Okay? And the mayor might come back and say, you know what, try to sharpen your pencil, bring those numbers down a little bit before we can go and take that to the council. Okay? So you do a little bit more work, and now you're ready to prepare this budget, and you take it to the council. You guys in the back are all the council members. So come to you and say, here's a budget. And you look at it and say, well, you know, I want to know what's in here, what's in public works, why are we spending this much money, why do you have so much money for snow removal, why do you have so much money for road repairs, and you go through this process. What are we doing? We're going through the process of budget formulation, right? Now the question is, the council now says, okay, we're good with this. Approved, budget is approved. Take that document and say, that was good. What do we do next? And this is what we're going to talk about today. What happens next? Well, you have the budget, right? You're going to spend money. What would you like to do from time to time? Compare what you spent with the budget, right? That has to be built within your accounting system. And for that reason, you can't go buy a commercial piece of software because the commercial system doesn't have this capability. So you need something where you have the budget and you can compare the actuals. So what we do is, and I'll go through this, but very simply, what we do is, so when we spend money in the governmental sense, what are they called? What are those? Is it expenses or expenditures? Expenditures. Budgetary. Remember, fiscal expenditures, right? And in order to make those payments of expenditure, what do we need? Money, right? And where is that money coming from mostly? Taxes. Those are what called what? Revenues, right? So we have revenues and expenditures. And sometimes we have odd things, such as getting money from another unit of the government itself, right? They are called transfers, right? Or giving money to some other governmental unit. And the word I'm looking for is other financing use or source, and we'll talk about each one of these as we go along, okay, as to what they are. For instance, when you raise money by issuing a bond, Remember what I told you about governmental funds? What happens on the fund financial statement? If you're doing this for your financial accounting class and you borrowed money, what would you do? Debit cash and credit? No, stable, right? Whatever, a long-term liability. In government funds, what do? Debit cash and other financing sources. Why do we do that? Because this other financing source is an account used to describe things other than revenues, where the money is coming into the government. If it's revenues, you put it in revenues. But if it's something strange, like money being raised through a bond issue, it goes into other financing sources. Now, the reason for my going through all this is, so there is a budget for revenues, and there is a budget for expenditures, which we call what? What's the word? Appropriation. That's why the word used, appropriating amount. Okay? Not budgeted expenditures, but appropriation. Okay? Now, in an ideal situation, your budgetary account, instead of calling it revenues, we call it estimated revenues. That's what we expect. Instead of saying estimated expenditures, we call it appropriation. In the ideal situation, revenues should equal what? Estimated revenues should equal actual revenues, right? If they're less, then what happens? I'm sorry, I should ask this way. If the actual revenues are less than your estimated revenues, which is your budget, is that good? Not good, because your actual revenues are less. And what happens then when it's less? You have to go and get the money from somewhere else, which is where? Usually the fund balance. Because you can't send another tax bill out to the taxpayers and say, oops, I made a mistake. Here's another tax bill. Okay? So you have to do that. So in an ideal situation, estimated revenues should equal appropriation. But it doesn't happen all the time. Sometimes one is higher, sometimes one is. But if you were the CFO of an organization, how would you set it up? If you had revenues, you estimated revenues at $10 million, and your appropriations were $10 million, would you want to receive exactly $10 million in revenue? Would you want more? That's the little amount that you want to have in case things go bad, right? I'll take a very simplistic example. It snows every week, okay? And what you have is your budget for snow removal goes right through the roof, okay? You need to be able to do that. So what I'm going to do now is I'm going to show you a statement which does that. And just look at the format for the time being, okay? Just for the time being, look at the format, okay? First of all, this is a budgetary statement. You know, the 75, oh yeah, the numbers are different on your book. But it's what page number 73, yes? 73 or 75 with a little number, okay? Notice the name of the statement, revenue expenditures and changes in fund balance, and budget and actual, budgetary basis. Now, please don't get confused, because there are lots of statements we're dealing with. Statement of activities, which was what? Revenues and expenses. Statement of revenues and expenditures, which is the fund-based statement. And now what? A budgetary statement. The third statement in a row. And you know what? They can all be different. And it's your job to figure out how to do each one of them right. They can all be different. Because remember I told you at the start, this statement can be prepared using governmental GAAP, which is not governmental GAAP. But in order for this to meet GASB's requirement, if you prepare your budget on a non-governmental GAAP basis, listen, if you prepare your budget on a non-governmental GAAP basis, this statement has to be prepared on a non-governmental GAAP basis. Because if you prepare this statement on a GAAP basis, you are preparing a statement which is not GAAP. We talk about a handful, right? Okay, listen. This statement itself has to be prepared on the same basis as your budget. So what does that mean? Well, you might have a municipality which says, you know what, I'm only going to use the cash basis of accounting. Cash basis is not, it's not governmental GAAP. What's governmental GAAP? Modified accrual basis. If they prepare this on a cash basis, if they prepare the budget on a cash basis, this statement better be on a cash basis. Because if you are an accountant or auditor and say, but you know what, you have to prepare this on a modified accrual basis, this will then become non-GAAP. Yep. No, because GASB will not tell you to do that. They will not tell you because it's not, they feel it's not their role to dictate to government how they should budget, including accounting practices. This is a big battle. Actually, I can talk about this for a whole class here because there was a treasurer in New Jersey many years ago who said, forget about all these different bases. We have to go on a GAAP basis. And you know what? We couldn't get anywhere. We couldn't get anywhere because this is what's been done in practice for a long time. And I don't want to make this more more than what it is. But what I want to tell you is that this statement is probably one of the most important statements for governmental financial management. And I don't mean to minimize the statement of activities, but you know what? They wouldn't care less. Why? Because this shows what? The original budget, the final budget. Why have a final budget if you have an original budget? Why change it? Well, something might happen during the year that might force you to change, like your snow removal budget. Okay? And what is this actual amount that you spent? Encumbrance we'll get to. This is the budgetary actual, and this is the variance, which is the difference between the actual and the budget itself. And the final budget. Yeah. Okay. So I want you to don't be concerned too much about the items. Notice another thing. These revenues, see the format different from the functional format of the governmental statement of activity, right? Yep. This is what people care about. And I don't mean to exaggerate this, but this is what people are really concerned about. What was the budget? How much I spent? What's left? Okay? All right, moving on ahead. And we'll take a look at more of this on this. Okay. So I was going to tell you about this little thing about the budget itself. Okay. So you have the budget. Okay. And you have your operating accounts. Okay. Remember I said to you, you have revenues, right? Under the budget, what do? You do the estimated revenues, right? And the difference between the two is your GAAP. Just like here in the operating account, you have expenditures, right? Here you have appropriation. If this has a credit balance, what do you think this would have? In order to get a difference, how do you get a difference? If one has a credit balance, this has to be what? A debit balance. If this has a debit balance, what does this have to have? Credit. What my point is that for all these major categories of revenues, you have a counterpart budgetary account. So if there is revenue, there is estimated revenue, which is a budgetary account. If it's expenditure, there is an appropriation, which is a budgetary account. If there is a other financing source, there is a budgetary estimated other. Okay, so there are these accounts that you will find. The what? I'm sorry. Okay. The estimated revenues with revenues, right? Appropriations with expenditures, right? Other financing sources with estimated other financing sources. It's just the use of the word estimated. And encumbrances I'll get to right now. Okay? So what I have just introduced to you is separate sets of budgetary accounts. Estimated, appropriation, financing uses, and this encumbrance and encumbrance outstanding, which we'll talk about in a minute. Okay? And these are actually recorded in the book. Say, geez, things were difficult as they are. Now what do we get into? But you know what? No stress. Because the reason why we're doing this is for the following. And I'll show you an example. All right? Everybody know the equation, right? Just don't worry about this stuff. Asset equals what? Liabilities plus the fund balance, right? All right? And we have the balance sheet accounts and the operating statement accounts and budgetary accounts. Notice one thing. In all the accounting, we know you have what? Balance sheet accounts and operating accounts, which get closed at the end of the year, right? We're introducing a third set of accounts, which is what? Budgetary. So you have balance sheet accounts, you have operating accounts or accounts that get closed at the end of the year, and then you have what? Budgetary accounts, which also get closed at the end of the year. Okay? Well, let me explain to you how that works, okay? Actually, you know what? We're going to go to that question right now. And let me see if I can find this for you. Is everybody still with me, or I see some people's eyes are kind of little, they're saying, what am I doing here? But you know what? I shouldn't say anything because I'm on video, so. I shouldn't say anything. Okay, just take a quick look at this at the bottom. And this is using that model, okay? This is from a revenue ledger. Okay, first of all, what do you see? Once the budget was adopted in the revenue ledger, there was an entry made, a debit entry for estimated revenue of $195,000. As the collections come in, the account is credited with real revenue. Why? Because this tells you almost how much more you have to still receive. So as of the end of January, how much more did you need in money to balance your budget? $181,000. So what this format allows you to do is to see how you're doing as you're going along. Whether you're meeting your revenue targets and your expenditure targets. That's the reason why we do it. Because, as I said to you, what is a budget? A budget is a financial plan. If you're the CFO of an organization, can you spend a dime without having the authority to spend that money? No. And what gives you the authority to spend that money? The budget. That gives you the authority to say, okay, I'm going to order this item under the budget. Okay? So, just like this, there is an expenditure ledger or appropriations ledger which we'll go into. That's the reason why we need these counterparts. We need these budgetary accounts and we need the real accounts to be side by side. So we can see what? We can see how we're doing. Because if we didn't, what you'd be doing is you'd be looking at budget and saying, okay, the budget was 195,000. I spent 100. I spent. I'm sorry. The budget for revenues was 195. I received 13,000. Okay, let me do the math. How much I have left? So this is integrated into this. And my point about talking about this is, if you ever had to buy a computerized accounting system for a public entity, what's one of the questions you're going to ask? Does it support what? Budgetary accounting. You just can't go by, what is that software, Peachtree or one of those others and say, no sweat, I can use it. Because what? You need a budgetary system to be in place. Yep. Yes, you can do that too. Yes, yes, you can do that.
Why couldn't you buy an off-the-shelf software program? Why do you need this budgetary accounting? Why can't you just do budget versus actually that budgetary accounting?
Well, because this budgetary accounting is a self-balancing set of books. All the budget accounts, all the debits and credits have to equal in the budgetary account. When you set up a budget manually, you can set up any budget you want. But here, the estimated revenues, classical case, has to equal the, yes, has to be, yes. Okay. All right. Any other questions? Everybody still with me? Okay, good. Thank you. I feel like I'm talking to the wall, Okay, we don't want people to fall asleep because, I started this and I didn't want to tell you all this at the start because but as we go along, maybe maybe Friday might be a little bit more involved, but things will stabilize. We'll finally get the concepts. I'm introducing to you the fundamental concepts in governmental accounting right now. Okay? So we learned the two bases. Now I'm introducing the budgetary accounting into this, and the next one we'll deal with is encumbrances. So I think once you get those important concepts down, the rest of it hopefully should not be that bad. The question is, what if you don't get those concepts down? Then you're going to have a problem. So my advice to you is, if you don't understand something, stop me, ask me. There's no question which, we're not born with this stuff, especially this kind of stuff, So let's talk about this. So remember I said to you, estimated revenues, in the ideal world, estimated revenues, your revenues should equal appropriations, right? That's your plan to spend money. If you are the CFO of an organization, is that what you want to do in your budget? Excellent. What he's saying is, I want to provide more than what I'm going to spend. Why? Because you want to have some money in case there's an issue or a problem, right? And that's what most people do. So what happens if your revenues are more than appropriations? Where does the difference go to? Surplus. We don't call it surplus, we call it budgetary fund balance. Okay? I will use the word budgetary fund balance and fund balance interchangeably, even though they are slightly different, but don't get confused about it. Just goes to what? Fund balance, okay? What if you were sitting on $1 million of, as she called it, surplus, and you go to the city council and they say, guys, we're all up for election this year. Let's reduce our taxes. What does that mean? It means that your estimated revenues are going to be less than your appropriation, your projected expenditure. And where are you going to get the money from? From the fund balance. And what does that do when you need less money, or most of your money comes from taxes? So what happens? The taxes come down and people are happy, right? So that's what this is. Okay. And we talked about this. We need to compare from time to time actual revenues to estimated revenues, and same thing with the other financing sources. Okay, and what you see on page 73 is a very nice chart of the different sets of accounts. For the time being, don't be concerned about the different categories of fund balance. Okay, assets equal liabilities plus fund balance. Everybody got that, right? Till last week we had only looked at this, but now we're looking at also these, the budgetary accounts. Okay, talk about estimated revenues, appropriation, other financing sources. We'll talk about encumbrances now. Okay. All right. So your budget got adopted. You're very happy. You are now going to make your first purchase. So you order $1,000 worth of supplies, whatever. What happens when you order something in government? Oh, let me just tell you one thing. The supplies budget was $10,000. So you ordered $1,000 worth of supplies. What do? Now, you haven't received anything yet. All you did was you wrote a purchase order and put it in the mail. Do you have to do something in your books? What do you have to do? You have to recognize an encumbrance, not expenditure yet, an encumbrance, right? An encumbrance for what? $1,000. Okay, the next person comes along and says, hey, I want to use this account. I'm getting some real great discount, and I can buy supplies for the whole year. And they're giving me a 20% discount. Budget was what? 10,000. How much have I encumbered? 1,000. I haven't gotten a piece of this thing yet. He or she comes along and says, you know, can you cut me a purchase order for $10,000? You look at the appropriation, 10,000, expenditure, 0. If you're in a business, it might be a little different. Say, oh, I have 10,000 there. I haven't spent it yet. I can give you, cut a purchase order for 10,000. But what happens in government? That 10,000, as soon as you order, it becomes an encumbrance. And what does the amount get reduced to? From 10,000 to, even though you haven't gotten it, right? So the reason for the encumbrance system is to prevent people from overspending an account. Okay, now let's take this to the next step. So you've ordered these supplies. Back comes a bill to you with the supplies. $1,000 worth of supplies. But you know what? You forgot to add the freight. It's $1,050 now, the total bill. Okay? Now, I want you to just listen and think about this. So you have an encumbrance outstanding of $1,000. You receive the item with a bill for $1,050. Okay? First of all, as soon as you receive the item, that encumbrance of $1,000 disappears because it's no longer an encumbrance. Now it's become what? An expenditure. Because what did you do? You received the item, right? So what happens in government is when you order something, you create an encumbrance. When you receive it, you cancel the encumbrance. And do what? Make it an expenditure. But what did I tell you? The item ordered was for $1,000, right? The bill came in with what? $9,050. But I only encumbered what? $8,000. So what do? I don't increase my encumbrance by $50. I just cancel the 1,000 and my expenditure is not what? 1,050. That $50 has to be deducted from what? The balance of that 9,000 that I told you about. Let me show you an example of how that's done so we don't lose it, okay? If you can understand this, you got the encumbrance system down, okay? We'll take a look at page 89. It's a little bit more complicated than the example that I just gave you, but I think you guys will get this. All right. So the budget, notice one thing. Encumbrance, expenditure, appropriation, okay? Budget was what? $1,150,000, right? $1,150,000. They issued a purchase order of what? $38,000, right? Everybody with me so far, right? Now this is what happened. They issued a purchase order. The person called back from the company, said, you know what? We got a back order for you of $3,000 worth of supplies we can't send you right now. We'll only send you $35,000. The $3,000 we'll send you in the next shipment. Okay? Listen, $3,000 in the next shipment, we'll send you $35,000. But oops, you know that $35,000 purchase order? It's going to cost you $35,100 because you forgot to add the freight charge. Everybody got the facts? Right? Okay, now see what happens. As soon as you did this, what did it do? It reduced your amount available, right? Because he or she fulfilled $35,000, you got to cancel the encumbrance for that amount, right? So what do you have left now? $3,000 under encumbrances. Everybody with me? Okay. What was the actual expenditure? $35,100, right? But notice what happens from here to here. It gets reduced by what? $100. Everybody get this thing? Now this can be as complicated or as simple as you see it. But you've got to understand how this process works. So here, this is where it all happened. But what happened was the difference between this number and this number was used to reduce it. And it can go the other way too. Now you might say, how does that translate into journal entries? I'll show you how that translates into journal entries. Actually, the journal entries are pretty straightforward on this. But what I wanted to do was show you how things are actually set up in the system itself. Yeah. Well, it's usually for that specific purchase order. If you decide to issue another purchase order for, you have to cancel that just for audit trail purposes.
So in this case, with the $3,000 that now gets canceled the order.
No, it's outstanding. It's outstanding. They'll get it later. So when they get the bill next time for $3,000, they'll cancel that, and that will happen. So what do you recognize here? What you recognize here is a very strange thing. As soon as you book an encumbrance, it's almost like an expenditure, isn't it? Because what happens? You reduce it, but it's not. And that's the reason why when we looked at the statement on page let me show you this. That's why we have the column encumbrance. Because what is happening is you're taking, in order to come up with the variance column, you're taking the actual, you're adding the encumbrance to come up with the total amount that you've spent. Notice the difference. Actual and encumbrance gives you the total amount that you've spent. And that allows you then to come up with that. Okay? So don't get confused, but I wanted to tell you how encumbrances play a role. That's it. Now I'm going to ask you a question which you have to research yourself and tell me next time. And this will maybe prompt you to read the next chapter. Okay. Your year ends on December 31st. On December 31st, somebody comes to you and says, you know, I need to purchase something today. I want to send out a purchase order for $10,000 for all this equipment. Write out the purchase order for $10,000. You know you're not going to get the bill or the item till next year. I want you to think about how that is handled. 2 different years. This is all within 1 year, right? Yeah. Well, that's a good point. But you know what? There's something else that goes on. I thought you were going to say this. In governments, there's a philosophy of use it or lose it. You ever hear of that? What it says is, if your department's given a budget for $10,000 and you don't use it, it doesn't get carried forward to the next year. If you use only $8,000, think about what happens. And this is one of the reasons why we have such bad financial problems. You're the manager sitting, you are very diligent with the way you spend money, and you only spend $8,000. And you come to me and say, hey, can I use the $2,000 I did this year, next year? I say, no, the appropriation's lapsed, over, done with this year. Now I'm sitting down to prepare my budget. What's the number I'm looking at? Okay, well, Jamie's he only spent $8,000. So that's all I'm going to give him. So what happened? This poor fellow who saved money, not only did he not spend all his money, but he's being now penalized next year by getting less because he only spent less. Do you see the problem? And this is very rampant. I can tell you by experience. A lot of purchasing, especially of computer equipment, occurs in the last week of the fiscal year. By the way, do you know what the word fiscal year means? Is it always calendar year, January 1 to December 31st? What state of New Jersey? July 1 to June 30th. What's federal government? I want you to find this out. Yeah. No, it has, and you know what? Things are changing. Things are changing because there are bright and young people like you folks who are out there and saying, you know what? Something's not right with this picture. There's something not right with this picture, but that's the way traditionally the process works. Yeah. No. Yeah, they look at last 3 years. Yeah, they look at a pattern, but whenever they see, and it's, as I said, it's very, very common. When they see that you haven't spent it, that means you don't need all that money, and that's why that causes us to spend more than we should. Yeah, yeah, yeah. Yeah. So, but yes. Right.
And I have a small business, and my company was located in Manhattan. And at one point, I was working with a guy at a small business development center located at City University, and he called me up and said, Liz, like, the government, I have so much money to give away. Like, come up with a need.
Sure. Sure.
I have to give this money.
Well, it is, and you know what? Those are unfortunately, it's, it's overreaction. In a lot of, look at the what happened with the, with the bailout fund. When you look at it, it's just sometimes we overreact, and when you overreact, you lose. And remember when I showed you the opinion of the federal government, which were the two departments, Department of Defense and Homeland Security. What's the common element between the two? You know that, right? So that unfortunately is a result of the way we work. Okay, two control accounts, as I said to you, estimated revenues are used to, I think we looked at these illustrations. Any questions so far? Everybody still with me? Okay, good. Thank you. Yeah. Let's take a look at these sources of revenue. We know these sources of revenues, but there's a reason we have them here. You need to understand a couple of things about each one of these. First, what are they? And two, how do you recognize them? And three, how do you record them? Right? Those are the things that you should know. What are they made up of? How do you, how do you record them? Right? What was the third thing? And when do you recognize them? Okay. Taxes. Let's take a look at the first item, taxes. And taxes are the most, why do we pay so much attention to taxes? Well, first of all, as you'll see, nobody likes them, but somebody has to pay them, and it's the largest source of revenue for a government, right? So we have different taxes, sales tax, income tax, but what we'll today look at is property tax, an example of that, okay? And anybody hear of the word ad valorem taxes, what that means? It's based on what? A tax based on the value of something. So property taxes in New Jersey, for instance, would qualify that. In some states, I think states like Virginia, they even tax your personal property, such as your belongings, your car, whatever. I think so. I'm not very familiar. Anyone have experience with that in terms of, I think some of the states like Virginia have that. There is, there's certain types, not your, but the more major classes of your property, such as an automobile. Okay, now I'm going to go through this, but rather than show you this, I want you to put your CFO hat. So now I've come to you and said the following. My budget is $10 million. Write that down. Your budget is that you want to spend is going to be $10 million. All right? So you need to raise $10 million. And I'm going to keep it very simple. We will assume for this example you have no other revenue sources. Just one, property taxes. Okay? Keep it very simple because I want you to see how the process works. The property in your town has property worth $500 million. Now let me explain to you what that means. Every piece of property is assigned a value, which is called, and you don't have to write this down, the aggregate assessed valuation, which is what the property is worth on the tax roll. Okay? So $500 million worth of property in your township. You need to raise what? $10 million. Right? Now I come back and say to you the following. By the way, when I talk about property values, there is property, for instance, in Newark itself, which is owned by the state or by the municipality. We call that tax-exempt property because they don't pay taxes. Churches, they don't pay taxes on their property. So it's minus all this money, okay? So it's just what the tax assessor came and assessed your property. Not market value, but what the tax assessor assessed you. So now I tell you, okay, we have to raise $10 million. actually, can I change this example for the math? Can I make this, no, let's leave it at that. Okay, this will be fine. Okay, $10 million. And what I have is, when I send the tax bills out to everyone, not everyone's going to pay. You say, why? Well, there are people who don't pay their, they can't afford to pay their taxes. And that's another story, what happens when you don't pay taxes. We won't go into that right now. And hey, so he asks me, what is the delinquency rate? I tell him, this is a very high number, but 4%. You won't be able to collect 4% of your tax. Got it? All right? So you'll be only able to collect what? 96% of your taxes. And that's it. What I want you to do is calculate for me on your little calculator the amount of something called gross levy. And you don't even know what that term is, which is how much of taxes should I raise from that 96% so that I'm not underwater. Okay? Let me explain this to you again. Listen. I need to raise $10 million. Okay? Only 96% of the people are going to pay my taxes. I have property worth $500 million. And I'm going to give you two more facts. We'll make this a lot of fun. Actually, one more fact. I own a home worth $300,000, and I want you to tell me how much taxes would I pay on my home. $300,000. Okay. Now, I don't care how you calculate it. Make it a math exercise. It doesn't matter how you calculate it, because there are 2 or 3 different ways to calculate it. And I know I made it a little complicated for you, but that's how we'll learn a little bit. All right, you know what? To make the math easier, I'll give you one more thing. Because the math, this will make it really easy. Remember I said to you I needed to raise $10 million from taxes? Assume that I get $400,000 from somewhere else, so I don't have to raise $10 million. I only need to raise $9.6 million. Now the math gets really easy, okay? Oh, you figured it out already? Okay, I was trying to, because some people didn't have their calculator, so, okay. So tell me, how did you calculate it? Yeah. Good. Good. Excellent. Okay, see what she said? In order to raise $10 million, I had to do what? Using the collection rate, it meant, what do I have to really finally raise? 10.4, so I get what? 10 million back. Okay? I have to get more, right? Okay. So the gross levy in this case is what? The $10.4 million. Okay? So can I just redo this example? So because I see some puzzle looks in the back. Okay? All right. And I'll go this step by step again. This is property taxes, total budget, appropriation budget, the amount that you need is $10 million from all revenue sources, $10 million. And I'll keep the math simpler, okay? 400,000 will be, you'll get it from program revenue. So what do you need? 9.6 million. Your collection rate is 96%. So 9.6 divided by your collection rate gives you $10 million, which is the amount that you need to raise, right? Because you need to raise 10 million because those 400,000, they're never going to pay up. I'm just, So what will you be left with? The 9.6. That's called the gross levy. And that's what this is. If some of you might not understand what that is, and I use the same example, required revenues divided by 0.96 is the gross levy. But I took you through the entire process. Everybody with me, or are you? Okay. All right, so now from the fictitious case to the real world case. And don't panic, because the example is a little bit more complicated than it should be, but nevertheless, it's something that you should at least understand how it's constructed. Okay? Yeah. In the real world, when you prepare your budget, you don't prepare it on the last day of the year. You prepare it a few months before the year end for the following year. So this year, their fiscal year is 2014, January 1 to December 31st. That's their fiscal year. That's what they're trying to work with, okay? When are they preparing this? On July 31st, 2013. 5 months ahead, they're trying to figure out how much taxes do they need to raise. Because once you know this, is it difficult to calculate the tax rate? No. If you knew you had to raise 10 million, you had $500 million worth of property, what's the tax rate? 2%. 2% times 300,000 is what? That's your taxes, right? That's no stretch. We know that. That's pretty easy. But this is the number that you need to pay attention to. So I want you to just take a look at this, because this has, as I said, it's a little bit more complicated than I wish it was. I'll read the numbers here. First, we need to take into account what we need for the rest of the year from this point going forward, July 31st to the end of this year. So the first line which says estimated expenditures, remainder fiscal year 2013. If you don't mind with a pencil, if you want to put it in your books, that's from August 1 to December 31st. Okay, that's what we need, the money. From August 1st to December 31st, that's 4.2 million. What else do we need? We need next year's money, which is the appropriation for the whole year, which is what? 8.46. Everybody get this? This year and now next year. And how much fund balance do we need at the beginning of the year? We need 510,000 at the beginning of 2015, which is 112015, 2015. You know what this is? This is the minimum rainy day fund that I want to have. This is, as she said, this is the surplus that I want at the end. Okay? So these are my resource requirements. Once you have your resource requirements, what's next? How are you going to get it? That's the next section. Well, how you're going to get it is what you have today, which is your current fund balance of 654,000. You have that today, right? You still have to get another installment of your taxes, which is what? 2,430,000. And you're going to get some more money from elsewhere of what? 1,960,000 remainder of this year, okay? And then what you're going to get from, the word is non-property tax source. Don't get confused. It's non-property, not property. This is coming from property. This is non-property. So basically what happens is, this is what you need, this is what you have, and the difference between these is what you need to raise through property taxes. Everybody got it? It's a complicated example, but this is how it works in real life. Yeah. Yes, yes, yes. Good point. Yeah, yeah, it is. Yeah.
I think like 5
Good question. You know where that comes in from? That's like miscellaneous. It's thrown in here, and it's thrown in here for next year. This is for a remainder of this year, and this is remainder of next year. Yeah. There are items which you don't recognize till you receive them, you know? Yeah. Anybody else? So this is a schedule which is prepared by the CFO, and once you have that number, no sweat. You got it. Once you have that number, it doesn't take a whole lot to figure out what the property tax should be. Because what it would be is what your collection rate is, right? You need to take that into account, because you have to take this number and divide that by the collection rate to give you what? The gross levy, and then take the gross levy and divide that by all the property that's in your town, and you come up with a tax rate. Mm-hmm. Yes, yes. No, you're absolutely right. You're absolutely right, and that's all the finagling that goes on. But just think about it this way. You know, I'm hoping when you finish with this class, and you go to a council meeting, you'll be able to see these things. You will be able to see the estimates. You know, you look at something and you know the recognition rule, and somebody has a crazy number, and you say, wait a minute, how did that work out? Somebody tells you the collection rate is 99.5%. You ask them, okay, what was your collection rate the previous year? And actually, New Jersey state government has a requirement on collection rates, because that's where funny business can happen. That you have to use a very realistic collection rate. This whole subject is, you can spend hours on property taxation and how it's done. And it's very interesting because this is what goes to people's pockets, you know, comes out from people's pockets, and they're very concerned about what goes on, you know. And in New Jersey, as you know, property taxes are a very, very big issue. I mean, when you have towns like South Orange, where a home, typical home pays $20,000 in taxes, and then you go across to a town in Morris County where those same value, the taxes are $7,000. You know, there's an issue there, isn't it? And I'm not making a commentary on who's right, but the point is, it's the bottom line. So that's why when people purchase homes, what's the first thing they look at? They look at what are going to be the taxes, and what's the second thing they look at? Actually, it should be the first thing. If you have kids, it's the school systems, right? And these are some of the factors, and that's why tax is such a big issue in New Jersey. Yeah.
Actually, through the real estate market.
Oh.
I know actually that one of the biggest problems for selling a lot of homes, even they are.
Yeah. So did you listen to what he said? What he said was one of the biggest problems with real estate. He has got a real estate agent's license. Is that one of the biggest issues is? Go ahead.
Property taxes. Like, I mean, like there's some houses which have like really high property taxes, and it's hard to justify like $30,000 in taxes on some of these houses, even if the school district is good.
That's right. Yeah. You know, I'll give you an example. Mountain Lake in Morris County, which has one of the best school systems. People don't mind paying a premium for property, don't mind paying the high taxes. Why? Because of the school system. Same thing in Chatham in Morris County. Madison, you know, these towns, people do that for that purpose. But these are the typical things that, you know, people are facing. And you probably see it more than anybody else, being in the real estate world. Okay, so we'll move on from this to some of the other sources. Special assessment taxes. I'll quickly go through these so we can go to some of the more important pieces. Anybody know what special assessments are? All right, so you own a home. There are several people who own a home right next to each other. Taking an example, the sidewalk is all torn up. The town comes in and says, "Got to fix the sidewalk." You don't do anything. Town comes in and says, "You know what? We'll fix it for you. But you know what? We'll do a special assessment on this." Meaning, you have to pay for it, not all at once over a period of time. So what they do is they go out, borrow money. I gave you a simple example, but these are large-scale improvements. For instance, building a road for a developer, or several entities that benefit from that road. So things like that, they are, that's where special assessment comes into being. And street repair, street cleaning, snow plowing. How could snow plowing work? Where would that be? I thought all snow plowing would be covered by your town. Where would it not? Yeah, sometimes there are, they'll do it for some private entity or a condo complex which is far away and the town has no obligation to do it. And they'll do it and they'll send them a bill. Okay. Licenses and permits, it's exactly what it says. New Jersey towns make a lot of money from what? Liquor licenses. And I'm not sure, but I'm not sure about this number. But in the Meadowlands, when they were beginning to put the Xanadu, and there were liquor licenses that were going to be sold, the state had to jump in because the towns wanted an exorbitant amount for liquor licenses. They raised a lot of money through that. So these are, again, also please look at the bottom part of it, how they're recognized. It's usually recorded when it's received. With property taxes, when are property taxes recognized on your books? Are they recognized when they're received? Or they're recognized in the year when they're levied? And there's that modified accrual basis which allows what? Up to 60 days after the end of the year. All right? To be received. Yeah. So if you receive, if you don't receive all your taxes, but if you receive them within 60 days after the end of the year, for the year in question, you can book them as this year's revenue. No, this is for property taxes. Yeah. Everybody, okay, intergovernmental revenues. Let me just explain to you what this is. The guys, intergovernmental revenues. Let's just take a quick look at this. Intergovernmental revenues are what? They are basically grants given to township, municipality. What would these grants be for? Anybody? No? For, yeah, roads. It could be for any project, for any of this. The important thing to recognize is, to understand is, what was the grant? What is the grant being used for? Right? Because that tells us where to put it, right? In the statement of activity. And the other important thing to know is, are there any conditions? So for instance, if the grant says you can only use it for this purpose, if the government sends you a check for $200,000 and says you can only use it for this purpose, can you book it as a revenue? No. Only after you've used it for that purpose. The government sends you another check for $200,000 and says $100,000, you can use it for anything, $100,000 this year and $100,000 next year. Can you book the entire $200,000 this year? No. What do? When you receive the cash, $100,000 goes into deferred revenue for next period. That's what time and eligibility requirements are. Okay? Yeah. Yes. Yeah, they could have multiple things. Yep, they could have multiple things. Most of the state grants aren't just given that way. There's usually something attached to it. Yes. 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 Actually, that leads to even a better question, which is that they are, see where it says expenditure driven? Usually the way it works is nobody gives you a check in advance. What do they want you to do? Send the money first, send your bill along with a statement to the government, and they send you a reimbursement. That's how it occurs most of the time. Okay? Not in all cases. And that's what that word qualifying expenditure means. Oh, a lot of, yeah. AARA, yes, big one. Yeah, yeah. Okay, yes, very, very good question. And I don't know if you know about this. AARA was probably one of the largest federal programs, okay? To spur up the economy, they allowed states to spend money on infrastructure, roads, okay, bridges, other infrastructure projects. In order to qualify for an infrastructure project, I'll give you one example with the organization that I was involved in previously. We used AARA money to put a solar system on a landfill, meaning generating electricity through solar cells. Okay? And large-scale project, because it wasn't that much, it was about $10 million. But the requirements for ARA are still very strict. What you have to do is there are various reports that are filed. The people who are building the project have to provide status reports, and then the government reimburses them for the work itself. There is this Buy America rule where you can only, for some of the projects, you can only purchase items that are made in the country and not made overseas, for instance. And so there are all these different rules for some of these. But for most road projects which are not AARA, if it's federal, they usually work with the State Department of Transportation and work with them, and it's pretty seamless because they, a lot of the road building is done through federal, through federal grants. And but you're right. In fact, if you get a chance, go to the federal government. There is an ARA website, and which shows you, click on New Jersey, you see all the projects in New Jersey funded by the federal government, and some very large projects. And what the states did was spend most of the money on roads. Yeah.